Good afternoon, everyone. On behalf of HDFC Securities, I welcome you all for the fourth quarter and full year FY18 earnings conference call of Dewan Housing. We have with us the management of Dewan, which includes Mr. Kapil Vadavan, CMD of the company, Harshil Mehta, who is Joint MD, Santosh Sharma, CFO, and Pranab Goel, who is the Head of HR. I'd like to hand over the conference to Kapil for his initial comments. Thank you, and over to you, sir.
Ladies and gentlemen, it's my pleasure to be here with you today. Let me start, giving a few comments before I hand over the call to Harshil and the team for their perspective for the year. It's been a very fruitful year for DHFL, and I'm proud of what the team has achieved so far. To all of us, crossing rupees 1 lakh crore mark in AUM is a matter of immense pride and a great milestone to recognize and celebrate. It also has set the beginning of a larger vision of making DHFL brand a household name. But there is a lot more work on anvil towards this objective. Fiscal 2018 has been a record year for disbursement volume and growth at DHFL as well. We disbursed more than 44,000 crores in the year, which shows the retail strength of our group in an economy that is and will continue to be propelled by our core middle income segment. Given DHFL's long history of being in the housing finance business and successfully catering to the affordable segment for almost 35 years, something which many others have not done earlier, and I reiterate, many others have not done earlier. DHFL today is in a sweet spot to continue this pace of growth in a sustainable manner for the foreseeable future. The focus of growth will be affordable housing finance, while the proportion of non-home loans, more so the project finance, will slowly taper down. While the macro environment has been quite favorable for affordable housing finance, underwriting, servicing, and collection is a skill that is not easy to build in a short span of time. DHFL, with its long vintage of data and experience of seeing multiple credit cycles, has made substantial strides to enhance its distribution prowess as well as back-end capability to maintain robust asset quality. And let me again reiterate here that on the back-end capability, I would imagine that DHFL as a housing finance company today has probably the best KPO for credit underwriting in the country, not just among housing finance companies, but amongst banks as well. DHFL's over 350 branches and touch points are catering to almost 90% of the addressable market in the country. The focus is to leverage these touch points to enable technology-driven increase in distribution coverage, while also ensuring that the OPEX ratio continues its downward trend. On funding, and I think that to us in DHFL is extremely critical and crucial. Whilst there is a large demand-supply gap on the asset side, but primarily on the liability is where the real winners and losers of tomorrow are going to be. We have a strong, robust, and diversified funding profile, which also includes a strong deposit-taking ability. From a macro standpoint, availability and cost of capital will be key differentiators in this space going forward. We have the capability to raise capital from all possible sources, including big-ticket retail, as was done 2 years ago through our public issue of non-convertible debentures, where we not only raised large amounts of debt from the public, but also ensured that it was first of its kind in the history of the Indian capital markets. We did our first masala bond issue of $150 million last month as well. The recent circular of RBI allowing HFCs to raise overseas funds through ECB route will further help HFC. It deserves a mention that deposits alone, and I say this again, deposits alone crossed rupees 10,000 crores mark last year on a retail customer base of close to 300,000. On capital, just like DHFL did in March 2017 with the life insurance stake sale, when DHFL and its shareholders realized a 1,969 crore gain or 63 rupees per share in book value accretion, the company's goal is to monetize its equity holding in the two other group entities and further augment DHFL capital base. Recall, DHFL has a 9% stake in Aadhar Housing Finance and 32% stake in Avance Financial Services. Both Aadhar and Avance have achieved sizable scale and profitability today, as can be seen in our earnings presentation. Monetization of these investments will not just provide non-dilutive capital for DHFL, but will also showcase the group's expertise in building robust businesses for the benefit of all stakeholders. As a group, with Bhavan Global Capital, the holding company for all our financial services businesses, with businesses in lending, life and general insurance, and asset management, asset and wealth management, has over 20 million customers, which gives us tremendous cross-sell opportunities across all entities. Our goal is to serve our customers across all their life cycle needs. I think with that, I look forward to an even better year at DHFL in 2019 and beyond. And with this, hand over the call to Harshil and the team for their comments. Thank you.
Thank you, sir. Good afternoon, ladies and gentlemen. Continuing forward on the basis of what the chairman just said, we ended the year with an AUM of 1,11,000 crores, up 33%, driven by strong growth across all product segments. This has been achieved while retaining our focus on low and middle income segment throughout our more than 3 decades of existence. Overall, as you would have seen, disbursements increased 57% for the full year to 44,800 crores, while disbursements for the quarter increased 81% versus quarter 4 of FY17 to 15,768 crores. Home loan disbursements for the year increased 35%, backed by strong growth in the affordable housing segment. At this stage, I would like to update to each of you that we have submitted more than 16,000 applications to National Housing Bank till date, with a total subsidy claim of more than 370 crores under Prime Minister Awas Yojana scheme. We have already received subsidies of up to 7,000 cases, which is more than 150 crores of subsidy. The PMAY scheme further reinforces our strong commitment to the affordable housing segment. In fact, we were awarded the best performing primary lending institution under Prime Minister Awas Yojana for MIG by National Housing Bank for our industry-beating performance. This should not come as a surprise for the simple fact that this is what we have been doing for the last 3 decades. This is only a testimony of how we are able to showcase the performance which we do in the target segment where we are present. At this stage, we would also like to inform that effective 11th April, we have also increased our prime lending rate by 20 basis points in line with the increase in the rates in the market. Loan against property and SME loans disbursements for the year doubled, backed by increasing financial formalization of the small and local entrepreneur segment. We saw good proposals from borrowers with strong cash flow in the businesses in this segment, and hence we have ramped up our disbursements in spite of maintaining stringent credit appraisal parameters. Although I would say that the analyst community does have a concern on the LAP asset quality in the market, we continue to maintain a very robust asset quality in our LAP portfolio with gross NPA range around 1%. We are confident of our ability to pick and choose the right set of borrowers and hence have been quite opportunistic in the LAP SME segment in FY19, and we would like to continue taking advantage in the short-term opportunities wherever available. Having said that, we also maintain that in the medium to long run, we will continue to maintain a disproportionate share of our book in the affordable housing space, which is around at 2/3 level. And our distribution network, processes, and market understanding enable us to be a leading affordable housing finance player. Higher levels of compliance, now made mandatory under the RERA regime in most states, help us mitigate risks in project finance and open up opportunities to fund comparatively larger projects, including commercial projects with better risk profile. As a result, we have been able to ramp up our project loans disbursement by more than 50% in FY18. Fresh sanctions for the full year increased 65% to 65,936 crores, further cementing the strong growth potential outlook. Home loans continue to contribute more than 3/5 of our book and are expected to increase further from the current levels. We, as well as a lot of market analysts and consultants, hold the view that affordable housing finance will be the primary growth driver for India's housing finance market for the foreseeable future. The formation of a real estate regulator, spate of incentives provided by the government, and the demand-supply outlook enable us to commit investments for the long term in the affordable housing space. Through this past financial year, we have made several improvements in our business processes and employee deployment, and the benefits are expected to flow in both on the business growth as well as on the cost efficiency parameters. Our cost-to-income ratio for FY18 was at 23.06%, significantly lower than historical levels. As the benefit of the changes continue to accrue in the P&L, the ratio is on a track to trend downwards. We have ramped up our penetration in and around the 349 offices, which have helped increase home loan login volumes by 51% to around 2.8 lakh cases. The path-breaking Green Utsavs, a unique concept of a home loan festival where we bring local builders and customers under the same roof in Tier 2 and Tier 3 towns, have also helped us deepen our network and builder relationships in smaller towns. Over the past 9 months, we organized 31 such Grah Utsav, which saw a footfall of more than 30,000 visitors. On the liability side, we continue to build on the good work we did in FY17. Share of debt capital market is at 40% of the total borrowings. This does not include the impact of our first masala bond issue that we concluded in April 2018 by raising $150 million. We have increased our securitization volumes sharply, selling down loan assets worth rupees 12,772 crores, up almost double of last year. Our share of off-balance sheet assets has gone up to 17% from 14% in last 1 year. We expect this number to go up as we continue to sell down good chunks of loan portfolio. The fixed deposit book has grown 51% year-on-year to 10,339 crores and currently accounts for 11% of the total liabilities, up from 8% in FY17. Fresh deposits increased 80% year-on-year to rupees 5,000 crores in spite of a 70 basis points reduction in interest costs that we offer. As a result, our market share on an incremental deposit has doubled to 20% in FY18. We have implemented the latest technology platform for the fixed deposit book. With the process and system efficiencies we are achieving, we are on the track to significantly increase our retail liability book and attract sticky retail money at a cost-effective rate. Our asset quality continues to be stable, with gross NPA at sub-1% levels, including standard asset provisions. We have provided more than 100% provisions against the NPA. We are confident of achieving a combination of strong business growth in healthy asset quality and decreasing OPEX ratio for FY19 as well. A positive market outlook and significant improvements in our business operations provide with the confidence to commit to strong profitability growth and superior shareholder value creation for the coming year. For FY19, we have estimated a 28 to 30% growth in disbursement, 22 to 24% growth in our assets under management. Basis that, we also expect the cost-to-income ratio to come down by another 50 to 60 basis points and profitability to grow at around 20 to 23% from FY18 level. We can now open the floor to Q&A session. Thank you very much.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you'd like to withdraw your request, you may do so by pressing star and 1 again. Participants are requested to ask 2 questions in the initial round and may join the queue for more questions. So the first question is from Mr. Kunal Shah from Edelweiss Securities. Mr. Kunal, please go ahead.
Yeah, congratulations. Great set of numbers and growth momentum.
Kunal, can I request you to speak up a bit, please? Your voice is a little low.
Yeah, sorry. So now, is it clear?
Yeah.
Yeah. So, firstly, congrats for a great growth momentum. I just wanted to know whatever has been the pickup in the overall disbursements, if we can get the broader breakup between the various segments. So we have it on the loan book side, but if we can get it on the disbursements as well, vis-a-vis Q4 of last year.
Okay. So you want to, Kunal, you want to understand growth of the product on a quarter basis or over the year?
Yeah, quarterly. So between home loan, LAP, project loans, and SME, how has been the disbursement?
Yeah, so home loans, if you were to compare quarter on quarter, quarterly YOY, home loans grew at 49%, LAP grew at 110%, project finance grew at 126%, and SME grew at 91%. So weighted average, we grew at 81%. However, I would like to add a caveat here that, quarter 4 of FY17 may not be the right base to compare because we had the demonetization effect. So if you were to look at FY18 over FY17, then the home loans grew at 35%, LAP grew at 106%, and project finance grew at 64%, SME grew at 94%, giving a weighted average growth of 57%.
Okay. And can I get the absolute numbers because we don't have it for Q4 of last year, so maybe in terms of the growth. Yeah.
Yeah. So if you look at the Q4 numbers, home loans is 6525, LAP is 4475, project finance is 3752, SME is 1016, giving you a total of 15768. That is 15,768 crores.
Okay. So project loans you mentioned 3,700 crores.
That's right. Yes.
Okay. And this, when I compare it with the last quarter, it would have been 1,900 odd crores. Q3.
1940.
Yeah, 1940. So in LAP and project loans, even sequentially, it has almost doubled. So LAP last time was 2325, now it is 4475. Okay.
Correct.
Okay. So home loan, it's like when we overall see in terms of the traction in the home loan, so that is like 13% quarter on quarter. Yeah. In larger part of the growth is coming from LAP and project loans in this particular quarter.
In this quarter, yes. But when you look at the quarter-on-quarter, the numbers on the home loans has been on a higher side without compromising on the ticket size.
True.
I think absolute terms, if you see, absolute terms, if you see, total is 15,000. The highest is the home loan, which is 6,525.
True. And looking at this kind of a momentum, what would be the overall outlook now in terms of the AUM growth for next 2 years, given the thrust which is also there on affordable housing? So how do we see it going forward?
Yeah, so if you look at the AUM growth, we are saying that we should be growing our AUM somewhere in the range of 22%, 24% in FY19.
Okay. And lastly, in terms of zero coupon bonds, what is the outstanding number?
The zero coupon bonds, so last, I think it is,
I think we don't have the details right now. Kunal, I can give it to you offline. I think we should be somewhere around 1,800 crores of bonds outstanding in zero coupon.
Yeah. Okay.
But I can give you exact numbers.
And hit to securities premium in this fiscal FY18 because that
I don't have any premium during the year you want or the quarterly?
Yeah, so maybe this entire year FY18, how much on zero coupon bonds we would have taken maybe we would have taken a hit on securities.
Yeah, so basically during the whole year the interest, whatever premium you are asking is 256 crores.
Okay. 266 in entire FY18.
Yeah.
Okay, perfect. Yeah.
Okay.
Thanks a lot and all the best.
So that's the total from the share premium. Share premium taken is 99 crores. 99 crores for the whole year is reduced from the share premium.
Okay, only 99 crores. And balance is in P&L.
That's right.
Oh, okay. So 116. Okay. Okay. Yeah, got it. Thank you.
Thank you, sir. So the next question is from Mr. Nitesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir, and congratulations for a great set of numbers, especially in the growth front. Sir, on the fee income, the growth was pretty high at 70% YOY. Any particular reason that it is just because of disbursement number pretty high for this quarter, or there is any one-off in this number?
So, Vikesh, which number you said as
non-interest income, which is 70% YOY, 161.
So basically, non-interest income comprised of some trademark fees and the processing fees and insurance commission all put together. So since there has been good business, there is good income from the insurance fees and processing fees, and then we have taken the trademark fees also. So that all put together, that has given the rise for that, what you are saying.
Okay, so is it a sustainable momentum? That's what I'm trying to understand. There is no one-off in this number.
So there are two parts to this. The license, the trademark fees which Santosh talked about is a one-time. But barring that, there was also the fee income which is directly related to the business. So whether it is a processing fee or whether it is a commission on account of doing cross-sell of insurance. So as the business continues to grow, you will see a consistent increase in the fee income as well.
What is the share of trademark fee in the non-interest income, if you can share?
43 crores.
43 crores. And secondly, you have guided for around 20-23% PAT growth and 20-23% AUM growth, despite the cost to income going down by 50 to 60 basis points. So are we expecting any further margin compression in our estimates and by not saying that PAT growth will be higher than AUM growth?
See, two reasons for that. One is AUM also is a function of the repayments which you see. Okay, so and like in the last quarter also we had talked about the repayments, and to that extent we have taken it almost as a part and parcel of running the business with higher repayments coming in. So while the top line of disbursements will grow at a faster pace, you will also have the repayments which will take place, and hence your AUM is on a lower pace of growth than compared to your disbursements. Second is the fact that yes, we are living in an environment where home loan is almost a product which is like a commodity. So your margins will always be under pressure, but that also we have taken it as a part and parcel of running this business. So you can continuously look at avenues to see how you are able to, number one, come up with products which help you sustain your margin. Number two, how you effectively constantly go and revisit your borrowing profile. And we have been aggressively working towards our borrowing profile. And for all of you who have been tracking this company over the last 3-4 years, would have seen and experienced that how the borrowing profile of the organization has changed, which has definitely led to huge savings with respect to how the cost of funds has also come down. So considering the fact that margins, like any other product, will continue to be under pressure, but then as an organization, we are also very clear with respect to what are the available avenues and available levers so that we are able to protect the margins in the range of 300 to 305 basis points.
Because if margins are protected and if we expect to see a cost-to-income improvement, logically the PAT growth should be higher than the loan book growth.
Yes.
Is that a reasonable assumption? Or?
No, that's right, Nidesh. The idea is we are giving our estimates in the call, but obviously these estimates will not be exactly similar, and I will be very frank here, these will not be exactly similar to whatever we will have internal. We will like to be a bit conservative in giving guidance, and that's what we have always been telling. Right? So the idea is, sorry, yes, please.
And then lastly, on the repayment rate, can you just share some trend in the retail housing space? How is the repayment rate shaping up? Because on headline number, the repayment rate looks pretty high because of the non-housing piece. How is the repayment rates and repayment rates in the pure housing space?
So there are two parts to this. One is your normal repayments which keep on coming, and second is your prepayments with respect to the early closure of the loan which gets balance transferred. And when you combine both of them, you are looking at an annualized pace in the range of anywhere between 10 to 12%. And what we have seen is that has remained fairly constant during the course of the year.
Okay, sir. That's it from my side. Thank you.
Thank you, sir. So the next question is from Subhranshu Mishra, MOSL Securities. Please go ahead.
Thank you so much for the opportunity, sir, and congratulations on the good set of numbers. Just wanted a data point.
Can you speak a bit louder, please?
Sure. Can you hear me now, sir?
Yes.
Right. Thank you for the opportunity, sir, and congratulations on the good set of numbers. I wanted to understand your construction finance book. How much of it, what percentage of it is domiciled in the top 5 cities? What is the average ticket size and the number of transactions that you have done in FY18 versus FY17?
So on the project finance, we are predominantly in the metro location and in the tier 2 markets. We are not in the tier 3 markets. Secondly, we have consciously stayed away from the NCR market. So this is the geographical spread which we have with respect to the projects. What was the second part to that?
Average ticket size and the number of transactions you've done in FY18 versus FY17.
Okay, I may not have an number of transactions. I may not have an immediate data with that. I can have it ensure that on an offline basis they connect with you. On the ticket size, I would say it ranges from as low as 50 crores to as high as maybe 500 crores. So an average of that will really not give you the right sense, but it's a combination because if you go to tier 2 market, then typically anywhere between 50, 70 crores does it. But in a city like Mumbai, then typically your ticket size may be in the range of 300, 500 crores.
Right. And this is on the disbursement level or the sanction level?
So this would be disbursement also. In some of those cases, you have sanctioned it and you have disbursed it also. In some cases, you have sanctioned amount and the disbursement is on a lower side because it's at the stage of construction.
Right. And so, just your outlook on the project finance / construction finance space in FY19 and FY20 for you as a company and for the industry as a whole, sir?
Yeah. So, overall, I would say with the regulator coming in, it does open up opportunity. While in the short term, we have capitalized on that, and maybe we may look at this year as well to see if we have good projects and good proposals coming in. We may capitalize on that. But I think beyond that, we do not really see project finance as a large portion of our overall composition of book, because you also got to remember that these are not long tenure loans like home loans, which goes up to 20 years. These are typically anywhere between 3-5 year loans. So, and as we have always maintained that it may peak to about 15-17% and then it's stable, and they may come at a stable composition in the range of about 7 to 10%.
Right. Sure, sir. Thank you for the time. Best of luck.
Yeah, thanks.
Thank you, sir. The next question is from Mr. Digant Haria from Antique Stock. Please go ahead.
Hi, congrats to the team. So my question is that most of the players in affordable housing segment have also still been suffering, and probably you, despite having such a large book, have reported the highest growth rate in that segment. So what is it that is working for us? Because as far as we understand, the industry is still not picked up so well. Be it general housing or affordable housing, both of them. So if you can highlight some company-specific things which have helped you, get to that 23% kind of an individual home loan growth.
Digant, I really do not have a very textbook answer to this, but all I can say, the proof of the pudding lies in its eating. So we have the Gra Utsav in Surat this weekend, first for the financial year, and I cordially invite you to our first Gra Utsav in Surat and see for yourself as to where the growth is coming in. And because, the numbers are here to say, and we have been very, very, very focused in terms of how we want to leverage our distribution network. How do we ensure that our teams stay on track as far as our target segment is concerned? And how do we ensure that, more than 7,000 to 10,000 of the projects which are approved by us, how do we ensure that we continue to track the home loan penetration in that by being at the builder's site on a daily basis, having those local contacts, and essentially I think it also boils down to strong discipline of sales management, meticulous planning, and I would say very, very detailed micromanagement all the way down to the markets and to the sales manager level to keep a focus. And one of the focus areas for us is, while you guys look at the disbursement level, our focus levels in the sales management is at the login levels, because that for us is the biggest raw material as to how the business is going to look like. And we continuously internally look at how our login numbers are moving, and that gives us an indication of how the market is moving.
Right. All right, Kapil, and last question is that, after this VERA, especially in the developer loan segment, do you see that, maybe the project sizes may have gone up, but maybe the yields have slightly fallen because, the good developers, will attract more and more lenders now because, VERA is making the sector more organized?
True. To a large extent, I agree with you on that, because even in the smaller towns we have seen, because see, it also comes, all this comes with compliance come with a cost. But at the same time, when it is compliant, you are also brings in an additional level of comfort that the plans are in place, the legal due diligence. Why you continue to do a second level of due diligence on that, but it does bring in comfort. And yes, as it becomes more organized, yields also dip. But again, it's a risk-reward relationship,
Right. Thanks, and all the best to your team for scaling new heights. Thanks.
So we'll see you in Surat this weekend, Digant.
Yes, I would love to attend. Thank you so much, sir.
I'll have my team get in touch with you.
Yes, sure, sir. Thank you.
Yeah.
Thank you, sir. The next question is from Mr. Manish Agarwal from Phillip Capital. Please go ahead, sir.
Yeah. Thanks for the opportunity. Just wanted to check, you've taken the PLR hike of 20 basis point. So it's not impacting on an immediate basis or is it timeline?
No, you'll see the impact of that in the month of April itself for the first 20 days.
Fine. And secondly, coming to the loan book mix, so we have seen the home loan proportion coming down to 61%. And in an opening remarks, you mentioned that going forward, probably this proportion will start increasing from this level. Now, where do we see this proportion settling down in 2 years' time? That's one. And how do one should look at the margin once this proportion starts increasing? Because if I see the last 5 to 7 quarters, despite increasing proportion of non-housing, your margins have remained more or less same.
Yeah. Manish, I appreciate your comments on this. Now, in the couple of years, we are saying that in couple of years' time, we should be in a position to creep up our home loans contribution towards close to the 2/3, which we have been saying. Because if you look at LAP or SME or for that project finance, for that matter project finance, the tenures are on a lower side compared to home loans. So as it starts getting repaid, you start filling it up by way of home loans. Now, as the home loan starts creeping up, you also need to look from a perspective at the delinquency levels on a home loan are really much lower than what typically you would see on the LAP, SME or project finance. Secondly, your provisioning norms also are different for home loans vis-a-vis non-home loans. So as that business also grows up, it will also have the impact on your requirements with respect to your provisioning norms or your delinquency norms, resulting also in your savings with respect to how your P&L shapes up. It gives us to that extent, that confidence that we should be able to maintain not just the NIMs, but also the margin. If I may add also,
I'm sorry to interrupt, sir. Sir, there is an echo from Mr. Manish's line. Mr. Manish, can you please use your headset, sir? Handset, please.
Yeah.
You may.
Yeah. Okay. If I were to add further to what I just said is, the more home loans, more opportunity for us to do securitization also, which frees up the capital and also gets us additional fee income for maintaining and managing the collection piece and the spreads on those portfolio. So to that extent, we believe that we should be fairly able to continue to protect our margins and profitability.
So, Mr. Manish got dropped, sir.
Okay.
Yeah, thank you. Dear participants, if you have any questions, please press star and 1 on your telephone keypad. So the next question is from Mr. Rakesh Jain from Jasper Capital. Please go ahead, sir.
So what would be your segmental NPAs, like in construction finance, affordable housing and LAP?
The segmental NPAs which we have is home loans at AUM level, segmental NPA home loan would be around 0.65, 0.66.
And construction finance, it would be around 1.20%. And LAP and all that would also be around 1.20% within that range.
And what would be your amount that you have received from the PMAY scheme for the current year?
We announced 150 crores is what we have already received. We have submitted claims to more than 370 crores.
Okay, thanks a lot.
Thank you, sir. The next question is from Mr. Kunal Shah from Edelweiss Securities, sir.
Hi, sir. This is Prakar. A couple of questions from my side. First is in terms of what is the credit cost during this quarter?
Sir, sorry to interrupt, sir. Can you be a little bit louder, please?
Am I audible now?
Yeah.
Please go ahead, sir.
Okay. What is the credit cost during the quarter?
Sorry, yeah. Can you repeat the question? Credit cost. For the quarter was around 0.59%.
0.58. So, sir, if I look at your employee expenses and other OPEX, which has gone up during this quarter, both on sequential and while I understand that it might not be comparable on a year-on-year basis because of low base, but if I had to get your run rate, employee expenses was somewhere close to around 89 crores, which went to around 100 crores this quarter, and plus other OPEX is also higher. Any particular reasons for that?
Employee expense. Employee expenses for what? Quarter 4?
Yeah, quarter 4.
Okay. So what we did this year was, since the business plan and everything, we had kept it ready by quarter 4 itself. Okay. And basis that and looking at the growth numbers which we have, we did not wait for the quarter 1 of this year to initiate our entire hiring and so on and so forth. So what we did is on quarter 4 itself, we went about ensuring that we get the right people on board and so that come 1st April of the year, start of the financial year, we have the necessary people on board to meet our growth numbers. So you see, to a certain extent, more than a normal growth or an expense with respect to manpower expenses compared to the previous quarter.
Okay. And what similar on other OPEX?
The OPEX, basically, as we have always been saying, Prakar, please look at it more from a yearly perspective rather than a quarterly perspective, because there can be different expenses budgeted and planned in different quarters. And if you see from a yearly perspective, our OPEX, other than our employee expenses, was YOY for the full year was up just around 14%.
Okay. And the last question from my side. So what percentage of the overall customer base will be eligible for various sort of government schemes?
So
on the home loan side.
What?
Eligible for various schemes.
See, on an average, if you look the home loans which we do on the retail side, almost, I would say, 2/3 of the customers are eligible for some or the other schemes of Government of India. It could be PMAY, Dewan Housing Fund, or it could be Urban Poor, or any of those schemes. And this is not something which is new. This is historically. There have been other schemes which have been running by Government of India. It's only that in the Prime Minister Awas Yojana, you have one new avenue which is middle income group.
Thank you so much, sir. That was very helpful.
Thank you, sir. The next question is from Mr. Harshit Toshniwal from Jefferies, sir. Please go ahead, sir.
Good set of numbers. A couple of questions, sir. So first on the incremental yield. So can you share your incremental yields on home loan and LAP and construction finance on maybe some just before the PLR hike?
So incremental yields was around 9.3. LAP was
on
sorry.
Yeah, sorry, sir. Continue.
Yeah, LAP would be around 11.30, 11.35 range. Project finance was around 13.70, and SME would be around 11.5.
Okay, sir. And another question, sir. This is more on the other income which you mentioned, that the insurance commission. I want to know that currently what is the attachment rate for our home loans, basically in the disbursals, how much percentage opt for a home insurance, life insurance?
Typically, I would say, overall, I would say we would be at about 70-75% attachment. But one of the ways we track internally is also on a ticket size basis, because as the ticket size goes up, the attachment falls exponentially. So, but yeah, overall, I would say we would be at about 75% attachment.
This is based on the number of loans, and in terms of value?
No, see, value is a function of his eligibility of the home loan and a function of the LTV. Okay, because as the ticket size goes up, my regulatory LTV comes down to 80%. If the ticket size goes down to 15 lakh, 20 lakh, 25 lakh, my LTV goes up to 90%. So it's a function of eligibility and it's a function of LTV as well.
No, sir, I'm asking that the Credit Protect insurance, which you cross-sell to customers, how much proportion of your home loan customers would have been opting for that?
So overall, I say 75% of the customers opt for my insurance, which protects my home loan.
Okay, and has this number increased significantly over the past 2 or 3 years? So if I compare it maybe 2 years earlier, was the number that high?
I would say our attachment numbers have been fairly consistent. Okay.
And any idea, sir, what would be the average commission rates on these? So if we sell a Credit Protect, then what would be our income recognition kind of thing for that?
Those are governed by IRDA guidelines. So IRDA guidelines, on that basis is how we get the commission payout.
So is it the maximum? So are we receiving the maximum which IRDA has allowed?
Yes. Yes.
Okay.
So we get exactly, because see, we are also audited and inspected by IRDA also, in addition to National Housing Bank, because we are also corporate agents for insurance companies. So we are also, to that extent, inspected and audited by IRDA.
Okay, sir. Thanks a lot.
Thank you, sir. So next question is from Mr. Sulaksh Chaudhary from Zaba Capital. Please go ahead, sir.
Hello.
Yes.
Hello. Yes. Hi, good afternoon. Just a couple of questions. One, if I look at your net worth increase YOY, it doesn't seem to reconcile with your profit growth, even if I adjust for dividends. So, and there's some difference of around 150 odd crores between in my calculation and the net worth. So, what is this gap of 150 crores because of?
So gap is basically, one is the whatever ZCB premium we are setting up against the share premium and other expenses, that is around 99 crore. Hello? Can you hear me?
Yeah. Okay.
So that's around 99. And then some, whatever ESR and all we have given, some amount is there. So largely it is the ZCB premium.
The dividends, I don't know how much dividend you are accounting for, but dividend will both constitute of both the interim dividend which was given in this year and the final dividend of previous year would come in this year. So the dividend impact would be closer to around 240 odd, including dividend tax. $230 to 40 odd crores.
I get 150 crores basically as a gap, correct?
Sorry?
Yeah, I am taking the two dividends, and the 150 crores gap which I'm talking about is after taking into account the interim and final dividend.
Yeah, so as I said that their premium, that ZCB 99 crore, and then whatever the ESR and to do that, some reduction is there, and then That is all. If you want exact numbers completely, then we can take offline. So these are the...
Yeah, so basically you're saying 100 crores of ZCB premium, 99 crores, and balance I didn't quite understand. What's the balance 50 crores because of?
Because of some ESAR schemes are given, and exactly data I can just get you offline.
HR schemes. So what kind of
ESOP and ESAR to employees.
Oh, so ESOPs are charged directly to P&L.
Yeah.
To balance sheet, okay.
So that's to balance sheet, I'm saying, yeah. So the exact number will take you offline. Can give you offline.
Okay, that's fair. Okay. Yeah, and you said there's this trademark expense one-off in the quarter. What was that about, and how big is it?
It's an income. First of all, it's not expense.
Income. Sorry, other income.
Yeah, so this we have received from general insurance company. We have lended our trademark to them. So this fees we have received from that company, DHFL General Insurance.
Okay, and this is a one-off, is it, or will be expected to recur?
No, this is one-off.
How much is it?
43 crores.
Got it. Okay, that's all recognized in this quarter.
Yes, sir.
Understood. Okay. Yeah, that's it for me. Thanks. And good luck.
Thank you.
Thank you, sir. There are no further questions. Now I hand over the floor to Mr. Parag Thakkar for closing comments. Over to you, sir. Mr. Parag?
Hello?
Yes.
Hello?
Sir.
Hello, can you hear me?
Yeah, please go ahead.
Sir, over to you for closing, sir.
Yeah, so on behalf of HDFC Securities, I'd like to thank the management team of DHFL for their valuable time and insights. I'd like to thank the participants as well for joining the call. Thank you.
Thank you. Thank you, Parag and Krishna. Thank you very much. And ladies and gentlemen, thank you very much for taking the time out and participating in the earnings call. Thank you very much. And we look forward to your continued support and look forward to your feedback. Till then, goodbye and have a nice day. Till we connect again after a quarter. Thank you very much.